The ongoing challenges in traditional investment avenues such as stocks, bonds, and real estate, especially in the face of rising interest rates, lead to a complex positioning dilemma. The current period is viewed as a time where safeguarding the return of money takes precedence over seeking a higher return on investment. It has become very important to maintain purchasing power in these uncertain times. A significant trend we're seeing is a considerable reduction in the amount of metal held in both the London Metals Exchange and the COMEX market. The move is orchestrated by knowledgeable and well-funded traders, signaling a notable change. Commercial banks are largely helping in taking assets out of ETFs, and there's a clear rise in the preference for holding physical commodities, especially gold and silver. This shift is described as extraordinary, with traders actively minimizing the counterparty risk and taking large-scale possession deliveries off the COMEX and LME. In a single day, the wealthiest individuals acquired 41% of all physical kilo bars on the COMEX market. This development is notable because major banks typically engage with 100-ounce or 400-ounce bars, making the kilo bars, predominantly dealt with by a group referred to as others, a distinct focus. This group is believed to comprise sovereign wealth funds and family offices representing highly sophisticated private investors. Traditionally, the Commitment of Traders report from COMEX delineated the positioning of commercial banks versus hedge funds. However, the rise of the others has added a new dimension to this landscape. This group, considered the most sophisticated private investors globally, is increasingly influencing market dynamics. A significant withdrawal of 175 million ounces of gold from the COMEX market, particularly in kilo bars, raises questions about the motivations behind such actions. This substantial movement of precious metals indicates a profound concern among major investors. The accelerated withdrawal of silver, setting records for its pace, adds to the confusion. Why is this metal being pulled out of exchanges, and where is it headed? The most significant players in the financial world are strategically positioning themselves, potentially foreseeing imminent challenges or uncertainties in the financial landscape. The big players in the financial landscape are consistently ahead of the average investor, strategically positioning themselves by leveraging the potential fraudulent prices on the platforms like COMEX. Gold and silver, traditionally recognized as hedges against inflation, are now gaining attention not just for their inherent value, but also for their unique feature of having no counterparty risk. The recent trend of massive withdrawals of precious metals from exchanges, removing counterparty risk entirely, has triggered an awakening. Beyond being a safeguard against inflation, these metals are becoming increasingly attractive as a means to escape the vulnerabilities associated with traditional Western-based assets like stocks, bonds, and real estate. The shift is evident in the growing global accumulation of precious metals, prompting calls for a new price-setting hub, with Moscow emerging as a favored location. The current narrative challenges the long-standing belief, commonly promoted in the West, that traditional assets alone are adequate. It urges a reevaluation of investment approaches. The key question posed is this: in a scenario where fixed income ensures a negative real return and equities encounter difficulties with increasing rates, what becomes the viable alternative, particularly as the 3-decade bull market in bonds seems to be concluding? Another intriguing aspect is the skepticism surrounding official inflation numbers. What's the accuracy of the inflation figures provided by institutions such as the Bureau of Labor Statistics? According to a report from the National Bureau of Economic Research, there is discrepancy between the current CPI-measured inflation and the metrics applied in the past, indicating a potential inflation rate of 9%. The historical inclination of politicians to choose inflation over austerity reminds us about ancient Roman times. The viewpoint challenges the conventional notion of a 2% inflation target, proposing that a lower or negative inflation rate could lead to an improved standard of living. Given the doubts surrounding the Federal Reserve's commitment to tackle inflation, we must look into the historical instances of resolute actions, such as the significant increase in the federal funds rate during the 1980 inflation period. The current intricacy stems from the Fed's extensive balance sheets, now standing at $9 trillion, primarily invested in interest-sensitive assets, leading to distortions in asset prices. The underlying notion is that the Federal Reserve might lack the resolve to enforce stringent measures against inflation. There is also the possibility that the Fed is more inclined to address the aftermath of hyperinflation rather than confront a depression. As interest rates are raised to counter inflation, potential challenges are anticipated, portraying a scenario where hyperinflation is considered a more acceptable outcome by the central bank. The Federal Reserve may be reluctant to take decisive actions against inflation due to concerns about the destabilizing impact of raising interest rates. This creates a complex situation in dealing with domestic inflation, as the potential repercussions of rate increases are seen as significant and unanticipated by many. It's not surprising that gold tends to experience seasonality, with historical lows often occurring in August. While the correlation between silver and gold might not be as high as 85%, it remains substantial. Currently, silver has shown some interesting movements, dipping below $22.50 and then rebounding above it. The relationship between silver and gold can vary, with either metal leading the other at different times. Analyzing monthly seasonality in gold returns reveals a significant shift since the 1970s, with the last 2 decades showing stronger averages in January and August. David Morgan, a respected consultant in the precious metals sector, discusses historical August trends in gold and suggests a potential weakening correlation with silver. He highlights that the gold-to-silver ratio entering the 80 to 100x range could signal a substantial rally in silver prices. Examining the Commitment of Traders report, Morgan points out a bullish sentiment, with banks shifting from short to long positions on silver. The current COT report indicates a positive outlook, with both commercial and non-commercial net positions favoring higher silver prices. In 2023, speculative positions in silver futures was dynamic, initially showing a net short position in early March. However, banking issues triggered by the collapse of SVB led to increased demand for silver futures among non-commercial users seeking portfolio hedging. Considering these factors, David Morgan sees promising opportunities in the current silver market setup. Meanwhile, the mainstream press is acknowledging the tightening of the silver market, estimating that it is entering a period of tightness unseen for decades. A significant portion of Americans, 26%, consider gold to be the best long-term investment in 2023, nearly doubling the 15% who held this view in 2022. In comparison, only 18% of Americans ranked stocks as a top long-term holding, down from 24% the previous year. David Morgan, in a recent interview, shared insights into the Commitment of Traders report, emphasizing its bullish outlook, with banks, typically short, now being net long, an infrequent occurrence. He acknowledges the challenge of precise timing in predicting trend changes based on COT data, but expresses confidence that a silver rally is imminent. Mainstream press reports have also started acknowledging the tightness in the silver market, a shift not seen for years. Despite a slowdown in retail demand, industrial demand remains robust. Interestingly, institutional investors are notably absent from the silver market, a factor worth considering given the positive outlook for silver's future. David Morgan expects metals to perform better by the year-end, driven by potential events that could shift the perception of average investors, possibly diverting them from stocks to precious metals. The challenge lies in the frustration of investors who experience a round trip between 2000 and 2011, and now, a decade later, find themselves back where they started. Despite the underperformance of stocks, the devaluation of currency appears almost inevitable, making precious metals, with their historical value, a compelling asset. What are your thoughts? Let us know in the comments. Thanks for watching. Until next time.